Hello everyone, welcome to our Egyptian online seminar group. First, you can phone jobs, then if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Robert Knechel. Robert Knechel is one of the top accounting thought leaders in the world. He is a professor of accounting at the University of Florida. He is currently the director of the International Accounting and Auditing Center. Robert is a professor of accounting research at the University of Auckland. He is on the board of the Foundation for Audit Research in Netherlands, and he is member of the Standards and Emerging Issue Advising Group of the Public Company. He has recently completed a term as a senior editor for the Accounting Review. He was honorary was the outstanding doctor in auditing award given by auditing session of the American Accounting Association. He has received the honorary doctors for BI Oslo and Nyenrode University. Now we will start our seminar with the Professor Robert Knechel.
Okay, well, thank you. I'm very glad to be here. I appreciate, Mohammed, your introduction. That was more than you had to say. But I chose this topic today. It's not a traditional research paper or study. It's really an overview of work I've been doing for possibly 20 years. My career in auditing started in 1977, a long time ago. My career at the University of Florida started in 1981, also a long time ago. And I've observed the evolution of the profession over that period of time. And there have been very large changes. And I'm going to be talking about some of those things today. I think we can all agree. I mean, my focus is on auditing. I'm an accounting professor, but I have a focus on auditing. And those of us who are familiar with the auditing world and the auditing profession, I'm sure are very aware that there's been all kinds of challenges thrown at us over the last decade or so. And so that's what I plan on talking about a bit. The title officially is Corporate Failures and the Challenges Facing the Auditing Profession, but I'm going to roam widely on this topic, as you'll see in a few minutes. I'd like to start with this quote because it lays the context for us. The profession is at a critical juncture. New and complex business arrangements and financial transactions have increased the risks of audits. Information technology has changed the nature and complexity of a company's records. Business failures generate wide media attention, litigation, and regulatory scrutiny, resulting in widespread skepticism of the objectivity of the profession. And I think that describes the world we live in at the moment quite well. However, that was written in 1994. So in some ways, it simply demonstrates that the more things change in auditing, the less they change, or the more they stay the same is maybe another way to say that. And so we face many of the same challenges, but it's pretty clear that technology has advanced, the business world has advanced, globalization has advanced, and so these things have only gotten even more complicated. So the question I'm going to try to address today is why are things actually different now? And one of the things I will touch upon is I am beginning to wonder if the auditing profession is at a tipping point where the solutions of the past may not, in fact, work very well going forward. So let me give you an overview of what I'm going to talk about. Okay, first of all, I have to fully disclose this presentation is based on a speech that I gave at the 2023 annual meeting of the International Forum of Independent Audit Regulators, also known as IFIR, which has 59 member states. So this was given in Washington, D.C. at their annual meeting, at which my understanding is 55 countries had their representatives. So this was a fascinating challenge when they asked me to give this speech. It was at the PCAOB approached me since it was being hosted in D.C., Washington, D.C. Many of the ideas were drawn from interviews with academics, practitioners, and regulators from IFIR countries, including the US, Germany, UK, Slovakia, Spain, Finland, Norway, Australia, Brazil, Japan, and South Africa. So I mention this because these ideas are not, I hope, are not completely US-centric. In fact, I believe they're not. Some are more or less based on US observations, but many of them are based on conversations I've had with regulators around the world. and as well as being based on relevant audit research, HR, human resources, and labor economics. Okay, so let me give you a quick overview of where we're going. First, I'm going to lay out some groundwork as context, some general observations. Then I'm going to address 4 specific challenges that I feel the profession is facing that are critical. There could be others. I'm sure other individuals might think other things may be important, but I think these are 4 fairly significant challenges right now. Human resources, evolution of technology, then I'll move into our world, audit, accounting education, and accounting research. And then finally, I'll talk about the basis for my hope for the future, which involves reconsidering old traditions in order to find some new solutions. So let me lay out some context first. So my general perspective, and not necessarily everyone's going to agree with this, but this is the lens through which I look at auditing, audit research, and the audit profession. Okay, I start with a basic assumption that audit is a highly respected profession. It's grounded on its valuable contribution to a greater good. We might call that a calling, right? Because we're using our professional judgment that benefit in ways that hopefully benefit society as a whole. And you can think of medicine, it does the same thing. Law, in theory, does the same thing. And so we are, in that sense, a profession. And personally, I do not like the use of the term audit industry, which you hear more and more these days. We're not an industry, and words matter. Profession suggests this benefit to society through our professional judgment. Okay, auditing is of most value in settings where trust matters the most. In our world, historically, that would be the world of financial information and financial reporting. And as we've seen over the last decade or so, we've expanded that view of the world to include non-financial information. We've also expanded to include the conduct of processes and behaviors, both at an individual and collective level. For example, internal control quality. Fiduciary and custodial relationships, where one party is relying upon some other party to essentially protect their assets, their data, something that they don't want to see lost. And I'll be talking about that particular issue in a little more detail in a few minutes. And then finally, this is a newer phenomenon, in my opinion, is third-party platforms and services. As organizations outsource many common activities that were embedded in a corporate environment in the past, the boundaries of what a corporation is seems to be blurred a bit. In economics, we talk about Coase's theorem as to what should be inside a company versus what can be done outside. And I think that's evolving quickly as we see more and more activities. For example, I'll just give you an example. Website management and design and security is often now done outside of an organization. In this world, developing the trust systems that underlie these activities is absolutely critical. And therefore, the demands for trust are expanding rapidly. And just to give 2 examples that we're talking about a lot is the world of cyber financing, something that I'm going to talk about in more detail in a few minutes, and the world of ESG reporting, or sustainability reporting. I will give a little plug. There's a sustainability conference coming up in the end of September, I believe. And it's hosted by the University of Notre Dame Center for Education and Research and Accounting by Peter Easton. And it's an online conference, and there's 2 days devoted to accounting and sustainability. I think if you're interested in that area, you should look at that. And also you can look at the related journal, Accounting in a Sustainable World Quarterly. If you just Google Accounting in a Sustainable World Quarterly, you get all this information. Finally, the last observation I'll make is that at the heart of all this is professionalism and judgment. That's what makes us unique. That's what makes us valuable in developing these trust systems. I mean, why do you go to a doctor? You go to a doctor because presumably they know things, they carry knowledge in their head, they carry expertise that you don't have, that we don't have as regular people who aren't doctors. Well, the same thing applies to what we do, right? We learn accounting, we learn auditing, we become experts in these fields so that other people don't have to do it. And so it is that knowledge that allows us to be trusted and be a part of the system that develop trust in a world that's becoming very complicated, which I will call the financial reporting ecosystem. So let me illustrate what I mean by that. Okay, we've heard the term ecosystem for decades now. It's usually meant in a biological sense. I actually Googled ecosystem, because we all do that, right? And all the first top 10 hits I got were all maps of the island in the movie Jurassic Park, the ecosystem where the dinosaurs were reinvented, so to speak. If you've seen that movie, it's interesting. But that's an example, I suppose, of an ecosystem. Well, that doesn't apply to us. We are an economic ecosystem, which can be defined as a network of businesses and individuals considered to resemble an ecological ecosystem because of its complex, interdependent parts. And that's the key. There's numerous moving parts in this ecosystem. So if we want to talk about financial reporting, we first start with the corporate environment or the business environment. And within that environment, there's a number of separate, we'll call them players or entities or participants that contribute to the quality of financial reporting. So first of all, we can start with the process owner. Now, what is that? The process owner is the person who actually executes transactions on a day-to-day basis. Somebody has to service the client, process payables, process receivables, take orders from customer and so on. These are the process owners. Why do they matter? Because this is where errors can occur. This is where problems can develop. Okay, because we know that, by the way, we also have a second element called internal control. And the whole point of internal control is to prevent and detect those errors. If they happen, we hopefully catch them in the internal control system. The third piece I'll mention then is the internal auditor, who kind of oversees the quality of both those pieces. And so they have a major role. Management also has a role. We often think of, when we talk about auditing, we talk of management as the problem. Well, they may be. Management incentives are very important to the audit. But in many ways, management is also a partner because, the way I would express it is management does not want their subordinates committing fraud as a general rule, right? Management may want to commit fraud themselves, but they probably don't want their subordinates in the day-to-day operations of the company making errors or worse, committing fraud. So management is actually aligned in a lot of ways for much of what the auditor is doing, but not everything. Because in the end, we do know the management may have some incentives to manipulate the financial statements. And then finally, we have the governance structures. This is the board, the audit committee, the oversight role. Okay, and out of all that, outside that orange ring, we will then release a financial report into the wild, so to speak, out into the world. And in order to get people to believe that financial report, we have the external auditor overseeing everything and evaluating it. But it doesn't really even stop there, because we also know there's a lot of influence that comes from outside the organization into this process, right? There's investors who are demanding information. There's regulators demanding certain behaviors. There's government, which could be part of the regulators, but it could also be other things like tax authorities. There's political activists, which are becoming very significant in this world of sustainability reporting now we have. We could think of others like labor unions or local municipalities where factories may be based. And then we have strategic partners. And this is something that I don't think gets enough attention because, again, with this outsourcing of activities to other parties that are not within that circle, those are strategic partners. And therefore, the reliability of the information can be very much dictated by what those strategic partners are doing and who they are. That's why in auditing, we have something called the service organization audits. So for example, go back 20 years ago, there was a company called ADP, still exists. They were basically started to outsource payroll transactions. So a company would send fundamental basic information to ADP. ADP would send back a ledger and all the paychecks or the electronic payments as we evolved. And so the payroll processing was done completely outside the boundaries of the corporation. And therefore, the reliability of that processing became very critical to the audit of the company who's using ADP. So service organization audits were about auditing a company like ADP. So those are the strategic partners. Okay, but we also know from history we have this cycle that seems to repeat. Scandal, investigation, introduce some reforms, sometimes repeat. So, for example, something goes wrong. We can call it Enron in the United States in 2002. We can call it Carillion, which does not have 3 L's in it, by the way, in the UK, Wirecard in Germany. Okay, so this is a global problem potentially. Something goes wrong, and there's a financial reporting and audit scandal. Okay, of course, people complain. Mostly you get these complaints from the media, from politicians, and nowadays regulators, not so much at the time of Enron, because there really wasn't any regulations, all basically, making the same demand. Where were the auditors? How could this have happened? And whether it's Enron or the 2008, 7 and 8 global financial crisis, the story kind of just repeats. So what happens then is after there's a scandal, there's investigations, often driven by agendas, which could be political, could be investor or economic. And I find it very interesting. The Bryden report out of the UK, the Competitive Market Authority in the UK, the Labour Party report in the UK, and the Kingman report in the UK, all these after Carillion. But if you put them side by side, they look very, very different because they're written with different agendas in mind. If you tried to read those 4 reports and figure out what we should do, you would not get a very clear picture at all. However, the reports then will lead to proposals with, regulatory or other proposals, which will be debated. And the idea is, of course, to make things better, make auditors better at their job. Okay, at some point after all this debate, there may be new rules and regulations that are imposed. And the interesting thing I find is that they're almost always imposed on the auditors, as if the auditor is the problem. Now, the auditor could be the problem, but if you go back to that ecosystem, different parts of that could break down. And we assume, this is a fundamental assumption we always make, that the auditor can compensate for failures in all the other components. Well, I'm not convinced that's true. One thing I wish we'd stop talking about audit failure and start talking about system failure, because that's what we're talking about, an integrated system. And so if management's going to commit fraud, we know they're not going to tell the auditor, and we know that there's some probability that it will get by the auditor, that auditors can't check everything. If the audit committee is actually not very good at their job, does that create problems for the auditor? I think it might. Anyway, so the auditor can't solve every problem, and I think more regulation should be addressing other components. But in any event, whatever comes out of the new regulation, the system will adjust. But here's the key. There's often unintended consequences, which will set the stage for the next crisis, possibly. And then something goes wrong, because something always goes wrong. And repeat the game. Rinse and try and repeat. Right? We've had the S&L crisis in the United States in the 1990s. We've had the dot-com bubble globally. We've had the Asian currency crisis globally. In the early 2000s, we had Enron and WorldCom, but we also had Parmalat in Italy and Ahold in the Netherlands. We had the global financial crisis in the mid-2000s, involving Lehman Brothers and other big banks, many of which were in the UK. And then more recently, we've had Carillion and Wirecard, where Carillion is spelled correctly, fortunately. A company I'm going to talk about in more detail in a minute, Americanas, which is in Brazil. And most recently, big name failure we've had is FTX, this cryptocurrency bank, so to speak. And Silicon Valley Bank, which was a cryptocurrency bank also, well, somewhat dependent on cryptocurrency, not purely cryptocurrency, in California, Silicon Valley Bank. So some things, again, the more things change, the more they stay the same. But here's the question that I think we rarely ask, that should be asked. What are the opportunity costs and deadweight loss of regulations that are actually aimed at the last scandal, but are going to be imposed on market participants who had nothing to do with that last scandal? Right? They're not responsible for that scandal. They may be honest and competent players in this financial reporting ecosystem, but they're going to be dictated to by these new regulations. In economics, this is called a deadweight loss, where you write a regulation to solve a problem that is isolated in 1 or 2 or 3 scenarios, but which does not exist in most of the market. But the rest of the market has to absorb that cost too. And this drives compliance costs up and up and up. And so at some point, one has to wonder, is there essentially a decreasing marginal utility to having that level of regulation imposed? I actually had breakfast with a board member of the PCAOB this week, and we had exactly this conversation because this individual is very concerned about that, which I found a very enlightening opinion to get from someone on the regulatory board of the United States. So I think this is something we should be talking about more. So let me talk for a few minutes about how the audit process has actually evolved, because it's fairly important to understand this. The problems just seem to be resurrecting themselves, but that doesn't mean the process hasn't evolved. So first, let me use my definition of what I mean by an audit. It's an idiosyncratic service. Now, the word in this idiosyncratic is important because it means it's unique to each client. Okay, with an unobservable outcome. Okay, what does that mean? It means that at the end of the audit, you get an audit report. That's observable. But what's not observable is the actual residual risk achieved by the audit itself. Audits are based on a fundamental model of audit risk, and the audit risk cannot be zero at the end of the audit for a number of reasons I won't go into. So there's going to be some trivial but unobservable, or non-trivial but unobservable risk that the auditor has missed something. It's conducted by experts, that's us, exercising professional judgment in an uncertain environment. Let's think about how complicated a company can be with their systems in place, operating in 50 countries, being audited by local auditors, all being combined and rolled up into a consolidated set of financial statements under a group audit. It's actually amazing to me that we don't have more mess ups, given how complex that is. And then this is all subject to regulatory pressure, actually subject to regulatory and market pressure, because the market demands high quality auditing. But again, the audit changes over time. It evolves. Okay. I went to my library, which is actually the building behind me on my screen. And I went into the library because, if you ask students today to go to the library, they'll say, what? What is a library? But if you go to the library, I went in there and I went to some dusty corner in the stacks, and I looked at a bunch of old auditing books from the 1930s. I was actually amazed how many were there. There were about 8 or 9. And so I just flipped through quickly each one to look at how auditors looked at inventory around 1930. And you know what? There was no discussion in any of those books about an auditor observing inventory at the premises of the client, suggesting that this was not a requirement at the time. Now, that's one of the fundamental requirements of standards. That was one of the first standards ever written once we started getting auditing standards. Observe inventory and confirm receivables. Right? If you move through time a bit, jump to the 1970s, which is when I was actually doing audits, I did a lot of auditing that I would basically say I was an external auditing, and for just full disclosure, I was working for Arthur Andersen. It was Arthur Andersen at the time, not just Andersen. But I was doing internal audit tests. Because in the 1970s, very few companies had internal audit departments. Mainly only banks had them. Now we have debates about that. Is it violate independence for an external auditor to do internal audit type tests? In the 1980s, we saw this increased use of indirect tests, particularly analytical procedures. And also we began to see this idea of relying upon internal control. Because why? Well, part of it, the transaction populations are becoming so complex and so large, we can't look at everything. The forest was becoming much too big for our sampling techniques to really give us a lot of comfort. So we had to look at procedures that would tell us something more about the forest as a whole and not just the individual transactions. In the 1980s, I don't think this is appreciated enough. In the 1980s, the United States deregulated advertising and solicitation. What does that mean? It means that in the United States, and it went around the world, like many bad ideas that come from the United States eventually go around the world. Some good ideas go around the world too, but this was a bad idea in my opinion. The US government, Federal Trade Commission said that professions could no longer prohibit their members from advertising. So before 1980, If you're a lawyer, a doctor, or a accountant, or a vet, I mean, a number of professions that this covered, you cannot advertise. You also couldn't solicit business. You could not call up somebody and say, hey, let me do your audit. Let me be your lawyer. They had to come to you. Now, why was that important? Because let's say you wanted to develop a new service, a non-audit service. You can't market it, right? You can't advertise it. You couldn't call up potential clients and try to talk them into hiring you. But when that deregulation came in and it flowed around the world, all of a sudden the auditors have an economic incentive to build new services called non-audit services and go out and sell them, actively sell them, aggressively sell them. And since then, we've been having the debate as what's appropriate and what's inappropriate from an independence point of view. But that changed the nature of the audit accounting profession. In the 1990s, we began to see service blending, which is a natural extension of non-audit services, but the idea we began to look at companies through a risk lens, a much more strategic or enterprise level risk lens, which opened up the areas of the organization that the auditor was going to address. In 2002, after the Enron debacle and the Sarbanes-Oxley Act of 2002, which created the Public Company Accounting Oversight, or the PCAOB, we got what was called the integrated audit, which is where we began for the first time to audit the internal control system itself and actually give an opinion on that. Now, that is not everywhere in the world, but some countries, for example, Japan, I believe, has that, and in a few other countries. Other countries have something similar, but it's more of an option than a requirement. After that, after 2004, when the integrated audit kicked in, we've just seen more and more regulatory intervention over time, including new standards, new enforcement, and the big prize is inspections, where the government regulator comes in and looks at the quality audits after the fact. And we know how that has changed the dynamic of the audit profession. Now, going forward, what are we talking about? Technology and more technology, whether it's data analytics or blockchain or generative AI. These topics are everywhere. We don't know where they're going to go. I was actually communicating by email with the regulators in Ireland this morning before I got on this call to check up on what they were doing, just to get a refresher. And basically, they're saying that the regulators aren't there because, as I was told, I thought this was true. It was true a year and a half ago, but it's still true. There's not a single regulatory body in the world that will accept AI evidence during their inspection. So AI can be used possibly in the background of audits, but it can't be used as primary evidence that will be given to an inspection. Will that change? Probably. But how it will change, who knows? So we've seen this evolution over time. But that's not the only dimension to change. We've also seen changes across clients. Like I said, clients are idiosyncratic. Everyone's a little different. They all have different transactions, different systems, different risks, different controls, different people. The list can go on. So auditors have to make trade-offs between types of procedures. How much planning do they do? How much internal control testing do they do? How much post-year-end testing do they do? Right? And that's going to be different for every client. In spite of the debate that goes on, there is a debate about, there is the fundamental essence of outsourcing versus insourcing assurance. What does the internal auditor do? What should the external auditor do? And how should they relate to each other? Okay. We see bundling across services, as in the NAS realm. And the one that I think is most important is the role and the quality of the other stakeholders in the ecosystem, which I've already mentioned. Those components, those participants are not going to be all of equal quality. You hope they're all high quality, but they may not be. For example, a board and an audit committee could be overly influenced by management. We still see that in spite of 20 years of regulation. And finally, the audit changes across auditors and even audit teams, right? They're specialists. We've got a large body of literature that talks about what is an auditing specialist or an industry specialist. Offices, we know that different offices can do different level of quality of work. Well, that's in the literature that addresses contagion effects. I have a paper that's just about to come out that actually looks at contagion effects in the audits of blockchain-enabled transactions. And there's pretty strong, and this is a brand new market, and we see contagion effects. Partners, I've done a lot of work in this field, and we know that there is such thing as partner style. Some partners are more aggressive than others, and they're all subject to their own internal incentives, and they're subject to various rotation schemes in different parts of the world where they come and go off as individual clients. Okay, and finally, as I said, we have differences even at the team level. One thing we're beginning to find out, and the Foundation for Audit Research has been instrumental in providing some of this research. I had an early paper in Australia where we show that team knowledge of the client is actually fairly important. The findings of my particular paper is client-specific knowledge is actually more important than industry-specific knowledge. And so that's something that's going to become more and more understandable as we move forward. However, we have to consider all this, and again, come back to my initial observation. The audit requires cooperation across a very complex network of participants with potentially competing incentives, and we have to make this work. We have to understand that in some aspects of the audit, we can expect cooperation. In other aspects of the audit, we may find that we're in conflict with the various stakeholders or participants. And that needs to be recognized in the process we go through. And I'm sure regulators always understand that quite the way they should, but if there's any regulators, I'll be glad to hear pushback on that. So let me get into the challenges. The first challenge I want to talk about is human resources. Okay, first, if people talk about the human resource supply chain problem in accounting, the first answer you get is the accounting firms should pay more. Okay, that is a piece. I grant that. And this slide illustrates that. Okay, the upper flow chart is an accounting group, math, stat, English lit, economics and accounting. Okay, and if out of that you get a job in the Big Four, probably accounting, probably in the audit practice, could be tax. Okay, the bottom one, without the accounting, might be set, for example, just to pick a degree, a mathematical economics degree, it could be an engineering degree, now it could be an IT degree, right? Okay, so what are the salaries that are commensurate with those degrees? Well, in 1977, it was $18,500 to start as an auditor in a Big Four firm. That's me, by the way. That's how I know the numbers, those numbers. And a consultant, if you go into economic consultancy, which I had an offer to do, I would have started at $15,000. Okay. Yeah, accounting was a better career path. What is it today? Well, I got some statistics from 2023. And that's generous. That's New York City, which is probably the highest paid market in the United States for accountants. And so $75,000 per year to go to work for a Big Four firm in the United States. The reason I say Big Four / Big Eight is because when I came into the market, there were 8, the Big Eight. In 1977, the consultancy salary was $98,000. So you see a flip-flop in how lucrative each career path is. And if you put it in terms of inflation adjusted, you can see how much the audit or accounting firms have lost. Okay, so that is a problem. Why does that continue to exist? Well, I don't have time to get into this particular aspect, but part of it is the business model and strategies of the large accounting firms, which basically date to the 1960s. It's still a pyramidal, top-down, hire an army of staff accountants. 110 to 14 years later, you have one audit partner left. There's a lot of wastage in that system. And it's based on using a lot of fairly inexpensive staff accountants to do the work. I could go on and on about that. I'm not going to. But there's more to this than that. First of all, times are changing. Demographics are changing. And I don't know how many of you are actually university professors and what countries you are, but I know in many countries at university, we're asking, where do all the students go? Part of the reason is accounting has traditionally been a starter profession. It was an entry point for first-generation college graduates to get into a professional career path. That, by the way, was me too. I mean, my parents were not professionals. And so it was a starter profession. At the University of Florida, when I started there in 1981, approximately 80%, maybe it was closer to 75% of the freshmen, the first-year students, were first-generation university students. So, I mean, we're talking 40-some years ago. Now, the average incoming, about 80% of the incoming freshmen are second or more generation university students. It's only about 20% who are first generation. Now, why does that matter? Well, it matters because if you're a child of professional parents, you see much more of the world and what the alternative career paths might be like. And so you see that law and finance or medicine or engineering are all viable career paths, all of which at the moment seem to have better work-life balance and better compensation. And then we're also dealing with increasing diversity across the board. Okay, so that's a changing demographic. Any of you with children under the age of, say, 23 know what Gen Z means. And there are changing attitudes in the cultures, changing expectations of what work-life balance should be. You talk to students, and I remember the story I got from a German regulator who told me, when we talk to students now, they don't buy into this. Look where you can be in 5 years if you go to work in public accounting. You can do almost anything. He said, now I get questions like, not what I'll be doing in 5 years, but when in the next 12 months can I go to Bali to go surfing? That's an exact quote, by the way. That's exactly what he said. Well, that's indicative of the change in mindset that we're seeing. And you talk to that generation of university students, and they expect to change jobs a lot. I mean, I saw a number. I don't remember. It was big number. How many different careers they expect to have. And so the term that's been coined is, instead of having a career path where you take one job and stick with it, we're having career chutes and ladders. And for those of you who are not Anglo-based, chutes and ladders is a kid's game where you go around a game board, and sometimes you hit a ladder that moves you up fast, and sometimes you hit a chute that takes you down fast. And so the idea that it's not actually embarrassing to go down in order to go up later. Okay, so that suggests a very roller coaster career. And then the one thing I think we're not truly appreciating quite as much as we need to, and that's the aftermath of the COVID pandemic, developing the ethos of professionalism. My son is in the professional world now, but he was a COVID graduate out of the university. And he talked to him. And since they don't go to the office, they don't necessarily see what it means to work like a professional in a professional team and in a professional environment with a client overseeing. You know, if you're sitting in your bedroom in your apartment doing everything online and not talking to real people for most of the day, it's a very different experience. And professionalism is fairly important to develop if you're talking about a profession. And then finally, I'll mention regulation. Okay. It's relevant in a couple of ways. It's relevant because of the historic barriers to entry. And I'm going to come back to that in a minute. Right, what it takes to become an accountant. When I talk about education, I'm going to talk about that. And it also is relevant to the messaging we get from regulators. I don't know, for example, I see a couple of people online who are in the Netherlands. They're very familiar with the $25 million fine that the KPMG, excuse me, the PCAOB imposed on the regulators in the Netherlands. Okay, so that's an American regulator fining a Dutch accounting firm $25 million. Biggest, I think it's the biggest penalty the PCAOB's ever leveled. What do you think that does to the attitude of university students who are thinking about going into accounting, right? They know about this. Sounds like it may not be a great career path with that kind of penalty structure being imposed on them. So again, it can drive some of the best and the brightest into law or finance. There's some issues related to work-life experience. For one thing, auditing is no longer considered a safe haven. And this is a quote I got from a regulator. Job pressures often include anxiety over the consequences of making an error, especially in a profession where judgment is required, but judgment will be second-guessed by many other people, including the PCAOB, even if you're not in the United States. And regulatory fines and penalties threaten individual professionals. Now, you might not be aware of this, but when the PCAOB imposes a fine on auditors, they have a rule that cannot be indemnified by directors and executives insurance. It has to be paid by the individuals. Okay, so if you're on a board, you get DOE insurance, and if the board has a problem and the Securities and Exchange Commission or the local regulator in your own country comes in and imposes a penalty, it's usually insured. So it doesn't come out of the pockets of the individuals. That's very different for auditors in the United States. There's an increasing focus on compliance, usually at a loss with less of an understanding of the whole business, of which much of the tradition of auditing is based. Okay, there's work stress, and it goes beyond just workload. Okay, yeah, 80 hours a week is not fun. it's stressful, and if you do it all year, it can be debilitating. But there's more to that also. Role ambiguity, not really knowing what you're supposed to do. Role conflict, where you have multiple bosses, or inter-role demand, where you have two different or three or four different bosses all at the same time. These create stress. Okay, so let me turn just for a minute to the economics here. That may help. Okay, so there's this is somewhere in the Harvard Business Review, I believe I got this from. This is called the information value chain, right? We start with some kind of context where we need information, and understanding the context is the value of X. Okay, we want to get data or information to understand that. Well, raw data, like some basic numbers, has a value of 3x is estimated. Turning that data into information that we can interpret makes it valuable at 10x. Turning that information into actual understanding and knowledge is 30x, which eventually leads to an actual decision, which, if it's a good decision, increases the value of that x up by a magnitude of 100. Okay, so that's the whole point. We move information moves through this chain, accumulating value as it becomes more and more relevant to the final conclusions. So where do we play? Where is the accountant in this process? Well, we're kind of at the beginning, right? That's what we did. We're in the first three boxes, so to speak. Information technology, they don't define the context of the information, but they respond to that demand. And then everybody else that probably competes for us for professionals is at the upper end of that value chain. So one question I think that the firms and the accounting profession need to be addressing is, can accountancy change its role in this value chain by moving it forward into the sustainable parts of the value chain? I don't know. There's a lot of controversy about how that might happen. So I can't answer that question. I just throw it out. So let me now turn to technology. Find out what am I doing on top. My phone is dead. Okay, so okay, I got plenty of time. Technology. There's good and bad to technology. Anybody who's working in the technology area sector knows this. But in accounting, it affects a potential trade-off of investments in capital for labor. In economics, right, marginal value of capital versus the marginal value of labor has to be in balance. And if the capital, meaning fixed assets, technology becomes cheaper and labor becomes more expensive, that balance changes. So the good is that by investing in scalable capital investments in IT, you can reduce your fixed costs, substitute fixed costs for high variable costs of labor by amortizing all that fixed cost over a lot of engagements. But the bad side, potentially, entry-level activities become redundant and career paths change, which means organizational structures have to change. We see that right now in the United States. Slightly over 40% of new hires in the big four firms are not coming from traditional accounting programs. Why? Because they need skill sets that we don't teach, like in IT and data analytics and things like that. The technology applications are primarily process-oriented so far. It's because we haven't really gotten into a true Gen AI type environment yet. The good speeds things up. Automated work papers, automated review modules, makes it easier to capture, document, and review completed audit steps. Clear gains in efficiency potential. The bad, and there's research showing people can over-rely on this or become distracted by it and actually not be asking the right questions that are possibly idiosyncratic to that client. It does transform professionals from data entry to data analyst, which is moving us up that value chain, right? The good, well, it improves the role of professional expertise and judgment, right? We're making very valuable judgments based on our knowledge and skill. The bad, if we don't have the adequate skill, which could be superficial, it could actually undermine our skill, called the skilling, and we're going to have to train and educate on these new skill sets, and which of course is a cost. Okay? And we have evidence, again, research evidence on all of those happening. So it's not, an all-purpose solution, IT. So a key question that I think we should be thinking about is how do we improve auditor understanding of trust structures, meaning these broader ecosystem environment, which includes things like, in our IT world now, identity management, authorization, zero trust systems. Now, how often now in your world, in your life, do you have to use dual authentication to get into your account or your something? And more importantly, counterparty risk, because counterparties are becoming a bigger and bigger part of the ecosystem in that they are the strategic partners identified in that slide. So let me give you an example of why that matters. Let me talk about the Americanas audit failure system failure in Brazil. Okay, Americanas is the largest retailer in Brazil. I think it was early 23 or late 22, they basically discovered to have a $6 billion fraud. Okay. Now the fraud actually was one of the simplest accounting transactions you could actually design. Okay, Americanas is a retailer. So they're on the left. At least I'm looking at it. They're the red thing. They have suppliers on the other side, right? So the supplier is essentially selling inventory to the retailer. It could be paper towels, it could be telephones, it could be diapers for babies, whatever it is. It's a very fundamental transaction. We all understand it. We all understand the accounting thing, right? Debit inventory, credit accounts payable. It goes on the balance sheet as a liability, okay? And a very common, I don't know if this applies in every country, but a very common trade term for this transaction is essentially, let's say it's a $100 transaction. If Americanas pays it in 10 days, they get a 2% discount, meaning they pay $98. If they pay it in 30 days, when it's totally finally due, they have to pay the full $100. Now, the implied interest rate, if you've ever had a finance course or maybe an accounting course, is very high. This is like over a 30% interest rate to use that $98 for 28 days. It's a ridiculously high interest rate. So the Americanas, the retailer, has all the incentive to pay that. Okay, but what happens if the retailer says, I can't pay it, or I don't want to pay it, or whatever? So there's a whole market that's developed in the last few years called reverse supply chain financing. So what they do is they go to a financial intermediary, call it a bank, and the bank pays. In the 10 days, the bank pays the supplier. So they'll pay $98 to the supplier. Okay, now the supplier's out of the transaction, right? They sold, they got paid, they're done. But the retailer now basically, the accounting is really simple, right? They no longer have a trade payable, they have a notes payable. So that's a simple reclassification. Okay. And so then what does the bank do? The bank says, okay, you pay us in 90 days. You pay us $99. So you do get a $1 discount and you get the money for 90 days and the implicit interest rate is 4.6% instead of over 30%. So that becomes a reasonable financing transaction. Okay. So this is becoming a bigger and bigger market. And by the way, all the big four sell these services on how to do this now. Okay, what did Americanas do? Americanas, when the bank paid off the supplier, they simply removed the account payable. So basically, there was $6 billion of unrecorded liabilities. Okay, they didn't record the note that they owed the bank. Now, that seems like something an auditor should be able to figure out because you send a confirmation to the bank, because we do that all the time too. Okay, that might help as long as you know that the transactions occurred, because this may not be one of their regular banks. This could be an electronic platform, for example. And furthermore, this whole thing can be blockchain enabled through cloud computing, basically. And in fact, in today's world, that may not even be a platform or a bank. It may be a smart contract, which is a direct contract between a buyer and seller enabled by blockchain, which is basically anonymous. Neither party knows who each other is. And it's run through the cyber currency world. So bottom line is, our traditional audit methods aren't going to work. And we don't know, I don't think we know really how to deal with this problem yet. I mean, I have a paper on smart contract auditing, as I said earlier, and it's really fascinating what they do. And potentially you write a contract, you put it in a blockchain, and it becomes self-executing. When certain things have happened, it executes automatically, including if you don't pay, the collateral is given to the lender. And it's all done, like, send it off and forget about it. It's all done automatically, but it is completely anonymous. So let me use a slightly different case then. You tell me who you think this is. Let's create an intangible. We're a company, okay? It's a business. We're going to create an intangible or an asset that nobody can take possession of. Okay? It has got tremendous fad value. People want to have this asset. It's traded in a non-traditional market. It's not going to go through a stock exchange. And the people buying this are low information investors. They're subject, the whole thing is subject to limited regulation or oversight. No one seems to have a jurisdiction here. It can be heavily influenced by current economic trends. You know, and the internet and social media drives this a lot these days. And it's subject to market manipulation by people who are inside the game, so to speak, right? So, who do you think this is? Just think about that for a second. Well, if you said FTX, you get a prize. You can ask Mohammed for a prize. So, because that's exactly what happened there, right? Cyber currency fits this model perfectly. Money, real money, pours into cyber money at amazing amount rates, and cyber currencies are not nearly as secure as people think they are. First of all, they're subject to extreme volatility in their pricing, but it also turns out, based on the paper I'm working on, that they're not hack-proof often. That in fact, the protocols on which these individual contracts are based could have security flaws. And someone can go in and essentially strip out the value of the cyber currencies that are inside there. Okay, so, but that's not the only one time this has happened. This is also Lehman Brothers, back in the global financial crisis, when you had this new thing called collateralized mortgage obligations and credit default swaps that money poured into, designed by PhDs in physics in Wall Street. Well, let's keep going. What about WorldCom and Global Crossing? Now, you may never have heard of Global Crossing in 2002, but you probably heard of WorldCom. Most people have. Telecom company. Global Crossing was also a telecom company. What was their fancy asset? Basically, telecommunication swapping of capacity on a digital network. And there was a market for this. So companies used it legitimately because nobody owned the entire global fiber optic network. So if you wanted to make a phone call, say from New York to London, you had to go through a local phone company in the US and a local phone company in London, but you had to go through Global Crossing. Their asset was they owned the only fiber optic under the, across the Atlantic Ocean. And they would trade these capacity in these contracts. And somebody brought this all down when they calculated, and analysts calculated the value of all these contracts on a global basis was more than the actual capacity of all the networks on a global basis. Okay, that collapsed. Enron was at the same time. And by the way, Enron was in that market too. Go back even farther, 1985. And I'm skipping some just, because you can't go through every one of these. ESM Government Securities. It was a Florida investment company. They basically took what was brand new transaction, repurchase agreements and reverse repurchase agreements and turned it into a fraud. Because essentially they were selling US government securities to banks, but these are electronic securities. Nobody takes possession of them. Okay, so you've got a number of a note payable from the US government, a treasury bill. You can sell that to 4 different banks and they won't know the difference because in 3 days, they're going to sell it back to you. Right? So nobody takes possession. Again, same idea. Actually, my slide is messed up. Nope. Okay. What happened? Well, the big reveal was going to be after this. In the earliest known case of this type of fraud was in 1637, called the Dutch East Indies tulip bubble. But for some reason, the slide doesn't work, so I apologize. It's the same idea. What's different is the technology, right? It's the same logic, all embedded in current technology. So the question is, what's next? What's going to happen in 2025 or later? I can speculate. I have some concern personally about carbon trading, right? You hear stories these days about methane recapture plants in different parts of the world, where you're essentially tranching the carbon credits. Tranching is a word that comes from the global financial crisis, right? In something that may not be verifiable, like how much carbon is really being captured there. And so who knows? But there's probably other examples you can think of. Okay, so moving on. Accounting education. Put this quote up. Many commentators tell us that accounting education is in trouble. It is not attracting enough of the right students. The curriculum is increasingly outdated. There are concerns about faculty incentives, instructional materials, accreditation, and professional examinations. Okay, again, very timely quote. But again, it's not recent, 1991. Okay, so again, the more things change, the more they stay the same. So let's talk about education. Okay, I've already mentioned how we're not seeing the same level of students. Okay, we can only work as a university with the students we get. There's a big belief that's building momentum, I think, in many countries that accounting education takes too long and is too costly. Now, in countries where they have subsidized university education, that's not true, but it's true in other parts of the world. Accounting majors in the firms are being supplanted by non-accounting degrees. I already mentioned that, the 50%, 40 to 50% statistic. So the real question I have to ask is, do accounting programs include the appropriate subject matter, given the commercial interests of the rest of this financial accounting ecosystem we have to work in? Okay, we see, for example, there's an increasing role for clinical and adjunct faculty who are going to develop courses that are profession-facing, meaning courses that the profession really wants to see. But faculty don't get tenured for doing that kind of stuff, right? They get tenured based on our real world, not on our real knowledge, but our reputation and our ability to publish, right? So there's potentially more need for experiential learning. The average tenured faculty member may or may not be interested or even able to develop that. So that's our problem. Okay, as an educator, that's my problem. Furthermore, just to give you an illustration, this was a survey done a couple years ago about what the firms thought students needed to know about IT and what they actually get covered in courses. Okay, data analytics, that's reasonable. That's getting there. IT audit, that's getting there, but it drops off really quick after there. You know, look at just the idea of digital acumen, 23%, cybersecurity, 40%. Okay, so basically, and it's not only that, but there's often a fundamental misunderstanding of what these things actually mean. If you talk to academics, what they say these things mean may be different than what the firms say they mean. So that's a problem. And just to illustrate how the curriculum has changed, okay, this is curriculum back in 1980, but basically when I started my academic career. Okay, we taught a lot about accounting. We talked a little bit about general business. We talked some about finance. We had a smidgen of AIS. And then we had this gray bar, which I couldn't even fit a word in for it, and that's analyzing risk. We've gotten better. We still teach a lot of accounting, but maybe it's come down a little. We teach more general business in which accounting has to operate. We teach more finance, which is really the most direct recipient of what we do. We talk a lot more about internal control because that's what auditors have to worry about. We talk about risk and we talk about data now, which we didn't really ever talk about. Where are we going to be in the future? Well, this is my pure speculation. Right? I think data and risk are going to become bigger and bigger and bigger pieces. And actual technical accounting knowledge is going to drop. Because why? Because technical financial accounting reporting actually is subject to some generative AI tools. And so, and if it's not, firms are starting, a while ago, started to build more technical expertise centers on tricky financial accounting issues. Don't leave it up to the audit team. That really started after Enron, where so much was left up to the field auditors in Houston to make the decisions about technical accounting issues, and they made some bad decisions about that. Okay, let me hit on my research. I'm an equal opportunity complainer, by unlike in other professions, accounting practitioners are not significant consumers of academic accounting. I mean, as a researcher, I'm always complaining. Why aren't the firms reading my papers? They're so brilliant. Well, partially because it's not in the language they understand. This is a lack of collaboration. It's not typical in other learned professions in the university, like medicine, engineering, or law, where much more research is considered to be clinical. Okay, so I have a family member who just graduated from medical school, and she published a paper in medicine on cancer treatments at a younger age than I published my own paper, which hurt my feelings. But anyway, now, they're doing this work because they're in clinical trials of things related to treatment plans. Engineering does the same thing. Law does the same thing. So we don't do that. And I think that's something that costs us in the long run. And then we complain that the accounting firms won't help us with our research. Now, that's not a universal. And the Foundation for Audit Research is doing a great job helping academics access data to do more clinical type research. Okay, so academic incentives diverge from what the profession thinks they need. So because of tenure promotion, publisher perish, and so on. QR theory, which is actually a real economic theory on how researchers are driven away from relevance into robustness, making things really rigorous, often at the cost of being relevant to practice. And that's been demonstrated in a lot of fields. We know that research is slow, right? It's slow to get done, it's slow to get reviewed, and it's slow to get published. And I have a paper coming out very soon, I hope. It takes over 2 years to get from submission to publication in accounting, on average. And that's at the journal where you succeed. If you already went to one journal and got rejected, you got to add that time in too. So the journal where you succeed, it still takes over 2 years. But interestingly, we also observed that accounting takes 5 months longer than other businesses, finance, management, marketing, on average. So accountants seem to be really, really inefficient somehow. And I don't have an answer to that, but I find that very telling in what it says about accounting research. Now it's all gloom and doom. I think the multinational global research efforts we're now seeing is really, really useful. Okay, first of all, by looking at things in different countries, and I've done a lot of this research, we get a natural experimentation, right? Different countries have different cultures, different routines, different regulations, different structures. And so we can test things in Egypt or Netherlands or Norway or China that we can't test in the United States or the UK, for example. We've got tremendous collaboration. When I first started doing international work, there were not that many countries, universities that had high-powered research groups. Now they're all over. China has many. Taiwan has a number. Australia, New Zealand, many countries in Europe, particularly the Netherlands, Belgium, UK, Germany, Austria. You see really high-class, high-quality research coming in, to the point we're actually seeing non-US PhDs getting jobs at the elite US schools, like Harvard, for example. Somebody from Maastricht in the Netherlands just got a job at the University of Illinois, which is arguably the top accounting university in the country. And we're seeing this broad distribution of findings, right? People around the world are now consuming this research, sometimes better than the Americans are, to be honest. Okay, so let me get to my final set of comments. New thinking, new solutions. Okay, let me first address what makes a profession attractive. Because that matters. It matters to a lot of things we should do to make adjustments to solve the problems I'm talking about, right? Well, profession, you hope, is going to be broadly admired, or at least respected. Okay? It's generally going to be trusted. Trust is critical. And when we hear that 30% of audits are failures year after year after year, you got to wonder how much trust that destroys. Intellectually satisfying for the participants. Economically rewarding, and that can vary upon the time you are in your career, right? And if you come in the United States, you're just coming out, you may have some students loan, and you have the lifestyle of youth, having fun probably. Long-term, family, lifestyle success. You want, especially today, people want to be socially valuable, but that was true in my time too. We believed that there was a public interest to what auditors were doing. Stable and secure career path. Now that's changing, to be honest. The idea of sideways or even downward moves is becoming more common as a career path versus career chutes and ladders. But people who have a mentality of accountants often want more secure. So what are the questions I would rethink? And this is just an example, a set of examples. First of all, what is an auditor? Are accounting programs really the best or even the only entry path for accounting? Okay, we see that the firms, for business reasons, are looking to other disciplines. Can we ignore that? Should we be building more integrated programs? Because, let's face it, an engineering professor can't teach accounting. A data analytics person is probably not going to teach accounting, but our students need to know data analytics. Okay, audit demand. What exactly is the professional value proposition, or do we take it for granted? On one of the phone calls, at the beginning, I talked about how I had interviews or discussions with regulators. There was one country I talked to, and it was actually the first country I talked to on a Zoom call. And the guy knew what I was going to be asking about, the problem with the human resources. Why is accounting not attractive to new university students? And he says, before you start, let me tell you what I think the problem is. And he said, it's not that accounting is unattractive. The problem is the value proposition of auditing has become unattractive and not understood well. And my reaction when he said that was, and it was great, this was the first conversation. I said, thank you for saying that, because that's exactly what I thought, and that's where I was going to go, and that should probably come through in some of the slides. So, but the bottom line is, do we take it for granted? Okay, independence. Independence is a bedrock, fundamental principle of auditing. But that graph about the financial reporting ecosystem shows we have to deal with many cooperative relationships to make this work. How do we balance the idea that we can have absolute independence in appearance against the reality that we have to interact, which could in fact influence our independence of mind? That's a challenge, I think, that hasn't been addressed. And I know that people in certain regulator groups are starting to talk about that. Auditor tenure, right? Europe now has a mandatory audit firm rotation. Other countries have done it or are looking at doing it. Is it really relevant? I don't have time to explain this in detail, but client-specific knowledge is very important. And when you force a change, you lose that, obviously. Non-audit services, we've been arguing about this for 40-some years. How important is that to the accounting firms to have these multidisciplinary skill sets? And if you outlaw non-audit services, do you in fact drive some of those skill sets away? Can they be replaced some way that is economical? Don't know. Audit report. Okay, we've been debating, so I won't go into it. Does it effectively communicate the level of assurance? Which, remember, the level of assurance is in the end is unobservable. So we need to communicate things about what we did to help people understand what assurance level we may try to achieve. But this leads automatically to the expectation gap. We've been hearing this one for a long time too. Can it be reduced within the financial reporting ecosystem? This is a topic I think that it's actually not even worth talking about anymore. Now that may sound radical, maybe the most controversial thing I've said, but the reason I say we should stop talking about the expectation gap is because, first of all, how do we define it? It's a difference between what people see after the audit compared to what the auditor had to do in real time. So we got pre and post hindsight here. Okay, so of course there's going to be some differences potentially, but it's even more fundamental because how many participants did we have in that slide? And as I said in another speech, I said, think about the person closest to you in life, the person you care about most. Do you ever have an expectation gap with that person? Well, I suspect we all do. I know I can say I have. Okay, so it's not clear to me we can ever resolve this, but we could possibly do a better job communicating. And I'm not saying I'm not blaming the investor here, by the way. I'm not saying investors don't understand what we do, which has been the profession's view for a long time. I'm saying we should really think about how we communicate what we do and also think about what our value proposition is. Audit standards, they're based on the idea of standardization. That was the point I made earlier about one size fits all, the deadweight loss of taking a solution to one problem and applying it to everybody who doesn't have that problem. Innovation, who should be driving that? And does escalating regulation result in unintended consequences that limit audit quality? And there is increasing research suggesting that is starting to occur. It has occurred. I did a study in Australia for the Australian Securities Commission about 10 years ago where we found that to be the case. And it was not just the auditor saying it, it was also the audit committee saying it. So these are tough questions. And we think we have a traditional answer to pretty much every one of these. And all I'm suggesting is we should maybe be thinking about other viewpoints to help us better inform these questions and hopefully lead to a better profession. So some final observations. Pretty clear, I hope. Challenges are not new, but the environment of auditing and the technology of auditing has certainly evolved and expanded, and it's going to continue, and it's doing it very rapidly. An opportunity. I'm just going to pick on one thing. ESG reporting or sustainability reporting, I think could lead us out of our doldrums rather than the desert, so to speak, because we have some unique advantages. Okay, we have established processes for verification. We understand how to evaluate risk, control, evidence, and materiality, right? I don't know that any of the competing professions that could provide sustainability assurance have that built up yet, right? And I think this is actually a value of our profession that we underestimate. Our ability to be a neutral, third-party, trusted assurance provider. Subject matter expert. Well, that's not our strength. Although we do have strengths in measurement, aggregation, and disclosure, right? Which is actually critical. You can't report a sustainability report unless you figure out how to capture the data, how to make sure it's reliable, how to aggregate the data, how to make sure that you report it and disclose it in a reasonable, clear fashion. These things we do understand. By the way, they take a lot of time to develop. You can't do this overnight. Quality control infrastructure. I make that a neutral face because I suspect other professions have their own quality control infrastructure. I just don't know what they are. So, okay, everybody has some quality control. But here's the kicker. Independence. Of all the professions we could identify, lawyers, engineers, social activists, we're the only one that has an independent structure that's well and truly embedded in our culture. And to be honest, that's fairly critical for giving assurance on anything. So I think there's a chance for renaissance in stewardship. If we look at what we do broader, sustainability, the politics of risk allocation, this is becoming a hot topic. It's not called that usually, but yeah, we all deal with issues. Well, if you're going to build a nuclear reactor, not that many countries are doing it anymore, where do you build it? If you're going to build a prison, where do you build it? Whose neighborhood it has to be somewhere, right? And there's a great book out of Germany. His name's Beck, Ulrich Beck, on basically the Risk Society, it's called. And it talks about this exact issue about how to, that in much of politics and economics now is more about figuring out where risks should reside in the society versus wealth. Okay. And finally, what kind of disruptive solutions are coming down? I don't know. We got generative AI, we got blockchain, we got monitoring capabilities, we got distance assurance, right? And that comes out of COVID. And that's a good thing, not just a bad thing, but a good thing. I raised the professionalism after this problem, but so we can provide assurance from distance. I think this is a great time to be an auditor. So let me end with a quote. We want to measure our contribution more by the quality of the service rendered than by whether we are making a good living out of it. It has been the view of accountants up to this time that their responsibility begins and ends with the certification of the balance sheet and the statement of earnings. I maintain that the responsibility of the public accountant begins rather than ends at this point. And I think if you consider what I've been saying for the last 15 minutes at least, since I went to the challenges or went into the future discussion, that's exactly what I'm trying to say. I'm saying it today in 2024. Somebody you probably have heard of said this in 1913. That is the founding of Arthur Andersen. Now, we know what happened to Andersen. Arthur Andersen himself was way gone by then. But that principle he laid down, I think, is still very relevant. So on that note, I'm going to quit. I think we have a few minutes. We got a few minutes, so I can look at the chat box and see if there's any questions. Let me pull it up.
Thank you very much, dear Professor Robert, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Now, if anyone have any questions, he or she can open your mic and ask your question.
Okay, let me look at the chat box real quick.
Yes.
The chat box, or if you want to, you can talk. But can you get a copy of the slide? We can arrange for that. There will be a little bit of editing. Some of this material is copyrighted, but you'll get the fundamentals. So any other questions? These all sound like nothing I need to talk about.
I think Joseph Chang, you can ask.
I kind of want to see the slide number 14 again. if that's okay.
Number
I
4.
can quickly look at the number 14 slide, please. Yeah, number 14.
In the wrong box. Sorry about that.
No.
Let me. That one.
Yes.
That one? Yep.
Yes. Yes. So work place experience. Okay. Okay. I want to make down. Okay.
You tell me where you are, Joseph.
Okay. Work stress and burnout due to more simply workload, low ambiguity, low conflict, and the interload demand. Yeah, I got that. Thank you.
Okay. Well,
Thank
where
you.
are you based, Joseph?
Okay. Thank you.
Where are you based?
Here in Ohio now.
Oh, Ohio. Okay. Thank you.
Yeah.
Anybody else?
Yes, if anyone have any questions, you can open your mic and ask your question. Yeah, Maron?
Oh, Maureen.
Yeah.
Hey, yeah, wonderful talk, Robert. I guess my question would be, I mean, you talk a lot about regulation and the potential for regulation to have gone too far and have unintended consequences and potentially its impacts on entry to the profession. And you mentioned your study from Australia. I mean, I think it is a challenge to get the balance right. And you highlighted all of these, fascinating, new challenges that we see, coming from cyber and crypto and all of these things. And it's sort of the question I would have is how would you advise academics about research they could conduct that will inform regulators on how to possibly strike the balance? A super hard question, but love to hear your thoughts about the general balance question, pulling back versus increasing regulation in these very challenging areas, and also how educators and academics can inform this.
Well, first of all, let me give you a little more background on that study I mentioned, because that was the first time that was something I kind of wondered about this idea of a tipping point in regulation. So that paper was done in Australia with individuals at Melbourne Uni and Monash Uni, and it was under the auspices of the Australian Research Council and the IAAC. And basically what we did was we studied regulators, audit partners, and audit committee members, and we got access to amazingly high-level people. And we use a theory that's called slippery slope theory, which talks about how regulation will tend to move from being light-handed to very, very heavy-handed. And so what we found out when we talked to the regulators, and we basically asked them about, how do you perceive your role has evolved? And they basically say, well, yeah, as we move through this, regulation gets better and better and better and better, and it goes up forever. Okay. We asked the audit partners, and they admitted that in the early days of regulation, it went up and up and up, and then they felt there was a tipping point and it would go down. Now, it may not surprise you that the partners would say that and the regulators would say up. So kind of like the tying vote was when we talked to the audit committee members, and we talked about 20 of them, including some of the very largest companies. And they sounded much more like the audit partners. They didn't sound like the regulators at all. And so I think that's what the punchline was from that study. Now, how do we address that? Well, that is a really hard question. Now, in the end, we have a lot of people chasing regulatory research using publicly available data. And that takes you a big step of the way. But I suspect there's also a diminishing marginal return to that approach. I mean, that's solid econometrics-based research. I mean, we've all learned that from our econometric courses and the economics literature. Sometimes I wonder how far that can really take us. So like I don't know anything about the paper. The title jumped out at me recently in SSRN. There was a study looking at airline delays and audit quality. I got in my inbox to look at. I don't know what that's going to tell me, but maybe it tells me something. But in the end, then we have to be able to get inside the doors. Now, PCAOB does that, obviously. And that I think is a great initiative they've undertaken because they have just tremendous wealth of data, but their data is their data. What they can't do is necessarily marry it to the company or client registrant data other than through the public financial statement. We used to be able to get in doors of accounting firms in the United States. I haven't done that in the United States since basically 1999, which is basically when the world changed, right after that. In the Netherlands Foundation for Audit Research, that is our mission, is to allow researchers in the doors. Unfortunately, Jan Bounds is on here, but he can correct me. I don't think we have the same success to the entry to the regulators in the Netherlands. And so this is it's got to be a cooperative process. And when I say, you've talked about how we don't interact with our professional community the way medicine law is, that's not just our fault, by the way. I think we can do more than we've done historically. But we have to have a receptive audience too. And I would point to back in my early career, back in say the 1990s, you'd go to a conference and you'd see partners from the large accounting firms there, and they would have PhDs on staff in their fields. Now you don't see that hardly at all. And I mean, the partners just show up to do a presentation and leave. So, I mean, the American Accounting Association just ended their annual conference. I met some people I knew there, but they were there and gone, right? And so we don't have that interaction. I don't have a magic answer to that, except for we just keep trying and I keep preaching, and we'll see where we get. So that's a long-winded answer, which means I don't have an answer.
Thank you, Robert. Terrific discussion and presentation.
Any other questions?
Yes, if anyone have any questions, you can open your mic and ask your.
Please ask.
I think Jan. Yeah. Busman, yeah? You can ask.
Okay.
Hey, Robert. Excellent presentation.
I'm not allowed to answer your question, Tibba.
So
Dutch colleagues, but go ahead.
kind of my point, or more an observation on how you see it. Might we be looking at some kind of catch-22 situation, right? Where the scandal tips off new regulation, which increase the entry barriers and also pushes out smaller players, in the end benefiting the big firms. But what's your view on that?
Well, that's okay. Now you're out. You just raised a couple of very interesting points. I wouldn't use catch-22. What I'd call it is a negative feedback loop. But it's fascinating that the firms may actually see it as a positive feedback loop, because every time a scandal happens, they end up making more money, it seems like.
Yes. Yeah.
And that does not flow through their internal operations and infrastructure all that well. I mean, trickles down, so to speak. I suspect a lot of the new money they're making now is being poured into IT development, because that's one of the problems. That's a whole different problem, which is it takes rather large capital investments to shift a basic economic enterprise from a labor-intensive world to a capital-intensive world. And if you think about the average audit, we talk of those as commodity price, meaning that they don't throw off a lot of free cash flow. So where does that cash flow come from? And one possibility is this ratcheting effect from regulation is allowing the firms to basically pull in more money. And the other possibility is the multidisciplinary firms. You get a cross-subsidization across service lines. Now, is that bad? I mean, a lot of people think that's terrible, but you also have to think about it. Think about the cash flow for auditing. Put it in a financial model, that's essentially an annuity with a low risk factor, right? It happens year after year, and you could actually infer a net present value of a new contract. Yeah, you may discount your fee in the first year. It's not lowballing by well, people call it lowballing, but it's not. We can't show that it's below cost. We can only show that the fee went down, so it's a fee discount. But the fee goes up and up and up, and eventually, until sometimes there may be an audit switch. So that annuity is fairly safe, and then the consulting practice we've seen, it goes up and down and up and down. So the certainty equivalent of that, or the net present value, is arguably not as high as people think it is, because it has to be for risk. And so we don't know what the real true difference is there. But anyway, yeah, I think the biggest problem here that we're raising is you need the money to make the investment, and which could be the reason. The other thing I look at, okay, the accounting firms have this pyramidal structure. They're based on a large number of junior people, and their salaries have stagnated for 20 years. They came up a bit during and after COVID because of what they call the Great Resignation, but they were pretty steady for a long time. But you need to hire a different skill set, these data analytic and AI people. they cost more, right? So they're up here. So now you've got fewer of these here, and these guys are up here costing more. And if your business model is based on an average cost based only on these guys, now you got a group that's paid even less. And what do we do? Where do we put them? We put them offshore.
Yeah.
In service centers. So I offset my higher cost data, and I'd love for the firm to let me study this, but nobody's volunteered yet. You offset your higher priced IT data and analytics people against the lower cost offshored auditing, routine work. For example, I know people who do this in Slovakia, country in Middle Central Europe. Well, that's an ex-communist country, and they don't have nearly the high salary structure that the Western Europe does. And furthermore, I was actually talking to the lead regulator there, and she was telling me the accounting firms actually have a double problem in Slovakia, and that's because they have to compete with their own service centers, which are a very stable, secure job, and for people who don't necessarily want to climb the ranks of the profession. And so the accounting graduates will be competed for by these service centers, their own firm service centers. So, I mean, these are the economics, I think, of the auditing profession are in transition, and we don't know enough about it. Is what the bottom line of all that. I'm speculating a lot.
Thank you.
Okay, Tibbet.
Yeah, Dua.
Just as a comment, Tibbet finished his PhD recently in Amsterdam. I was there to be examining him. So congratulations to Tim.
Yeah, congratulations. Yeah, Dua.
Hello, hi. Hello, hi.
Hello.
I would like just to thank you all for organizing this. That was a fascinating presentation. My name is Dua, and I'm from the UK. I really like your presentation. It freshens my mind. I actually have one point and one question.
Okay.
The point is, are we like, is there like any still like a perception about like the accounting? Is it still a graduate job, or we have to set all our benchmarks against preparing a lifelong learner to teach them how to learn, because we are in a dynamic change environment? So that was a debate in my department.
I'm very familiar with that debate, and I have an opinion on that. So, but finish your comment and question.
Yeah. The second question is about like the new international sustainability standards set by the international, the sustainability board. The IFRS S1 and S2, like they say a materiality one. I can understand things about the climate, because the climate, like they started doing it since, since time ago. But when it comes to sustainability related stuff for S1, and they are talking about materiality, how do we define materiality? And like, this is a question from like me as an accountant, could be me as an auditor.
Okay. Well, first of all, where in the UK are you?
Which university?
Yeah, where are you in the UK?
Yeah, University of Northampton. Yeah.
Okay. I'm going to be in London in a few weeks. But anyway, okay. So let me deal with the education one. Florida was one of the very first states in the United. It was actually the first major state in the United States to adopt what we call the 150-hour rule, which is in theory equivalent to getting a master's degree. Okay. I've never been a big supporter of that, and not because I don't. The way I frame the question is, it's not about. It shouldn't. The discussion shouldn't be about less education. The discussion should be about better education. And what we see has happened across the U.S. where I'm most familiar is, we added a fifth year of education, but we just made it more accounting. And based on my slides, you can see I think we're not necessarily teaching the right things. Right now, there's a debate going on nationally in the U.S. to get rid of the 150-hour rule, to actually create a path where you only get to a 3-year degree in accounting. And I understand in the UK, there is a path where the firms can hire you straight out of high school and you bypass university altogether. And so, we're looking for creative solutions, but in my mind, you are absolutely on point. How do you prepare someone for a profession? And we're the only profession that I know of that does not require a graduate school, right? Law, medicine, engineering. they all have, and nobody questions, engineering has a 5-year program too in most places, and nobody questions it. Why is it that we have this debate? And I think that traces back to the business model of firms to some extent. The other thing is the market segment. We don't recognize the market segments in the United States. The American Institute of CPAs, which is the biggest organization, professional body that's not a regulator, 90% of their members are small SMEs or SMPs, small and medium-sized practices. They don't have the same problems as the big 4 or the big 6 who have to audit multinational companies. And we only have one level of licensing here. And so as a result, it's neither fish nor fowl in a sense as to how we do this. Now, let me turn that to your sustainability question. At this point, I don't have an opinion per se about materiality in the sustainability world. I mean, dual materiality is a discussion clearly going on. I'm concerned it becomes N materiality, because even in the sustainability report, we don't have apples and apples and apples. We got apples and oranges and grapes and pears. Exactly. And so are we going to be having a different materiality level for every separate disclosure, because you can't combine carbon disclosures with late workforce disclosures? And so I'm really concerned that becomes an issue. One of the beautiful things about accounting, in the end, we bring it all down to a single number that we can all agree on, except, as far as I know, in the last 100 years, we still argue about what earnings are. So how are we going to agree on 35 metrics that don't reconcile with each other? I mean, I'm not saying we shouldn't be doing this, but the problems are very serious, much more serious than I think is often acknowledged. If you go online to the climate conference, Peter Easton's climate conference associated with accountability and sustainable world, I'm running a panel on this exact question. So at this point, I would say I'm agnostic about the materiality decision. I just see some serious challenges that are not being addressed adequately yet. There's going to be some growing pains, no doubt about it.
Yeah, I'm getting lots of drafts and exposure drafts will come in. Like, it's a lot of
Well, let me make
questions
another
about.
comment. You mentioned the standards. I mean, the IAAC came out with their first draft standard for sustainability assurance, 3 or 4 years ago. I happened to be in Australia at the time, and I happened to be in Canberra, which is the capital of Australia. And I know people there, and the head of their ASIC asked me if I could come and talk to them for half a day about this. I hadn't even read the proposal because it literally just came out, so I quickly skimmed through it. And the thing that jumped out of me, and I think we're all aware of this now, is that they wrote their standard on assurance to be profession agnostic, right? Any profession could oppose these standards. And the concern I raised and talked about, and I'm actually now having conversations with the European Union because they're dealing with this right now, is that let's say an engineering firm goes and wants to do sustainability assurance, and they say they're going to use the IAAC standard, but they don't have any of the other infrastructure that goes with that, right? They don't have the quality control system. They don't have the long experience with evidence and risk and control. They don't have independence infrastructure. The things I highlighted as our strengths. How do you make them do that? Well, now the most recent IAAC draft basically invokes IASBA, the International Ethics Standards Board for Accounting, saying if you're going to use this standard, you're going to have to use that standard too. And EU is working on legislation to say if you're going to give assurance on sustainability in the EU, you're going to have to do that. You're going to have to do that. That may not go through. Who knows? I mean, at this point, it's a proposal, and there's other political forces at work that may say that doesn't work. And then here's what I'm concerned about. You're looking at a few pictures on the screen. I'm going to say most of you are way too young to remember something called Web Trust, which was developed by the US and Canada jointly. They spent millions of dollars developing a assurance service aimed at making online retail or customers trust online selling platforms. At this point, it was very early days. And so the idea is a lot of people wouldn't trust these online platforms. Am I going to give my credit card number off into the Ethernet somewhere? And so they developed a system called Web Trust, where you basically hire them to do an audit of your your customer interface and security. Okay, it was a great service. It was also very expensive, and you had to do it 4 times a year. to get this, and you get a certificate, electronic certificate, will go on your website. Guess what?
Yeah.
At its peak, WebTrust had a grand total of 15 clients across the entire world. Because by the time you actually rolled it out, you had VeriSign, you had Better Business Bureau, you had credit card adjustments on fraud protection. All these things are much cheaper. And so WebTrust disappeared. And that's what my concern is. If we don't have this almost like a legal mandate that you could get a race to the bottom, right? Race to the bottom of sustainability insurance. And then, did you get what you wanted? I don't know. I don't know saying that's going to happen. The EU certainly is aware of that, and Australia is aware of that, but we got to see how this all plays out. And New Zealand, I believe, has already done this. They already have these rules in place.
Yeah. Yeah. Thank you so much. Thank you. Thank you.
My pleasure. My pleasure. Anybody else?
Yeah,
I
are
think
there
we're
other-
over time. I'm happy to answer another question if we got time. But Mohammed, you're in charge, so I'll leave it up to you.
yeah, are there another questions? I think there's some questions in the chat. Jan, Professor Jan, yes.
Well, can you save the chat and send it to me and I'll reach out to people individually and let everybody else go.
Yes, I think another question from Kasicha. Kasicha, word you can ask.
Okay, that's the only one I see. I didn't scroll all the way to the top. Kashia, is that how you pronounce it?
It's Kasha. Can you hear me?
Kasha, okay. The disconnect between accounting, academic research, and practice is not a new problem. It's absolutely true. In fact, this was a paper presented at the 2024 annual aware of
So
Well, actually, yeah. I mean,
feedback on it and see what you think.
it's not. You're absolutely right. It's not a new problem. You know, I remember when I started my PhD program. They made us read Ball and Brown, 1968, the first real econometric-based research in accounting. Before that, you look at the accounting review before that, it was all practice commentary, basically. But as soon as I came out, and the Ford educational charity, I forget what they're called, Ford Foundation, I guess, pushed our world into more of a research-based world. And where did we turn? We turned to economics, which is fine. We are a subset of economics, applied subset. And then at the time in the 1970s, when I entered my PhD program, there were only a small number of PhD programs that had taken that model, like Chicago, Berkeley, Stanford, Wharton, maybe Cornell, Dartmouth. I didn't go to any of the schools. I went to the University of North Carolina, Chapel Hill, which is right now is a leading accounting research program. But then they weren't. So I actually studied operations research, to be honest. I was an accountant, but I didn't major in accounting in my PhD program. Which has really colored my thinking about a lot of issues. And you're right. So there's been this force. Now, think about what's published. Think about what gets tenure. Think about what gets pay raises. Yeah, we've got this incentive structure built in now. Can we turn that ship around? I don't know. I think the biggest force that might work to that, those of us in accounting programs at universities depend upon support from the profession in one way or another.
Mm-hmm.
If their money when they start hiring 30 to 40% of their people from my campus, from the University of Florida, but they're coming from other places than accounting, they're going to start giving their money to other places.
Okay.
And then you get to a point where, okay, I retire. Well, we don't need another person to replace him because we don't have that many students anymore. You know, and I don't think the younger generation of academics truly appreciates how that might happen. But anyway, we don't know. It's the future's a mystery, as they say. But if we don't recognize there is an issue here, we're not going to solve it, have any chance.
Yeah. So
No.
basically, like my thought of it is like, is it really just a problem that we see within like our research, or is it a bigger problem where we're seeing it within research, we're seeing it within teaching, and we're seeing it within service, to where essentially it's a disconnect across the board. So just fixing it with research isn't a big problem.
Education. I mentioned education. I had, that was one of my. I had 2 bullet points on academia, right?
Yeah.
That's an interesting thing you raised about service. Yeah, I mean, that's actually an interesting point. And I suspect that's also a problem that the high level faculty often disconnect.
Okay.
I love going to PCAOB meetings. Right? I mean, this is part of what I do, but I'm old. You've got an idea how old I am from the dates I'm throwing out. But yeah, I look at my junior, but still very senior faculty, and you don't see nearly as much of that
Yeah.
that reaching out and interacting with the real world accounting. Tax people seem to be a little better at it than accounting people, or other accounting people. And I think auditing is a little better than accounting too, but yeah. I mean, I remember Bill Kinney from Texas. I would joke, Bill, when you retire, who's going to replace you? Because the contacts he had were amazing. So anyway, that was
Oh,
2
no,
years
thank you so
ago.
much.
Contacts now, but anyway, yeah. Well, in the end, I'm a believer in economics. It's about incentives.
Yeah.
Okay.
Yes. Yeah.
I
Thank
think
you.
I need to go at this point. I've got
Yeah.
it's coming up on noon here, and I've got a noon meeting I got to get ready for.
Thank
So
you very
thank
much.
you for inviting me, and thank you for letting me do this.
Thank you very much, the Professor Robert Knechel, for your contribution and your effort. Thank you very much. Thank you very much, everyone joining us today. And thank you very much, the Professor Robert, for taking the time to present to us today. It's been really appreciated, the Professor Robert Knechel. Thank you very much.
And hello to everybody I know, and hello to some of my potential new friends in the future. Take care. Thank you.
Yeah, well,
Thank you, Professor.
Yeah, and I hope to
Thank
see you
you,
soon in
Dr.
Egypt.
Muhammad.
You are very welcome.
Inshallah.
Send me an email.
Thank you.
Yeah.